Ladies and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. Thank you, as always, for listening. This episode features Al Goldstein of Stoic Lane. I'm going to read straight from the marketing material here. Who is Stoic Lane? Stoic Lane consolidates small businesses at 4 to 6 times EBITDA, adding technology to drive robust cash flow yields and IRRs with tax-efficient compounding. Now, I wanted to talk to Al for a couple reasons, but Adam Wyden introduced us, and Adam said Al's doing some interesting stuff. Got on the phone with Al and went through some questions, and then found out that he was structured as a corporation, and he really is thinking very long about the entity that he's building. And if you like what you hear, reach out to Stoic Lane. Al strikes me as a good dude, and he's trying to build something. So I hope you all enjoy the episode. It's a different kind of episode, so I don't think any disclaimers are needed, given the fact that this is illiquid and requires some accreditation. However, just in case they are, nothing in this podcast is investment advice. Everything is for informational and entertainment purposes only. Please consult your financial advisor before making investment decisions. Do your own due diligence, and treat everything you hear on podcasts with a healthy dose of skepticism. All right. Thank you all for listening, and enjoy the episode. All right, everybody. Ladies and gentlemen, as I like to say, welcome to the Business Brew. We are joined today by Al Goldstein of Stoic Lane, and Al is doing some interesting things in private markets, so we're going to have a little chat here and see how it goes. How you doing today?
Doing great. Thanks, Bill. Thanks for having me on.
Friend of the pod, Adam Wyden, was the person that made the introduction, so thank you to Adam for that. Al, do you want to give people a little bit of your background so that they know where you're coming from?
Yeah, no, for sure. But by the way, hopefully you don't hear this building getting knocked down behind me here in the middle of Miami Brickell.
Creative destruction, no worries.
Love the creative destruction. Like you said, thank you to Adam for making the connection. But I'll give you super quick background, I guess, on me and a little bit of Stoic. So immigrant kid. Was born in the former Soviet Union in Uzbekistan. I don't know how many listeners here have gotten the chance to go to that part of the world. Grew up in Chicago and started my career in investment banking in New York at Deutsche Bank, and lasted pretty much 12 minutes or something to that effect.
Why so short?
Yeah, no, well, so I think you and I talked about this a little bit, but learned a ton in the first 6 months, 9 months, worked crazy hours. That was great. But fairly quickly, I think my learning plateaued, and we were very process oriented. And I had a chance to quit and go do a startup when I was very young, when I was 23 years old, 20 years ago. And my co-founder in that startup, who was a mentor of mine, I'm still very close with, he said something to the effect of, I want to give you the opportunity to benefit from your own hard work. And yeah, he kind of neglected the whole fact of, like, give up your nice salary and cushy job and work for peanuts and move back in with your parents in Chicago. Like that whole thing fell by the wayside. But needless to say, we did it. My older brother, joined as really, the co-founder, third co-founder, first employee, in addition to me and Dave Shore, who's my original mentor. And we built this company that very quickly grew to a significant scale. And we started really one of the first online lending, consumer lending platforms, ended up selling it to a public company over the course of 4 years or so, and we did great. Our investors did phenomenally well, and we did something like a 70x return on capital from that business.
Was this Innova, or did you sell to Innova?
We sold Innova, but it wasn't called Innova at the time.
Okay.
So the company was called CashNet USA, which is still the brand for Innova for the U.S. market.
Okay.
And it became basically the business it is today. So that's part of kind of my I think learning experience of my narrative is I've watched that business continue to compound and grow for the past 15 years now, since 2008, late 2008 when I left. And that company today generates double in cash flow what we got paid.
Wow.
And so it's a really big company. And so I think it really ingrained this idea that the eighth wonder of the world is compounding. sort of this idea that if you have a good business with barriers to entry, great culture, sort of advantages relative to competition, that business can continue to grow for a long time.
Did you have a sense of how it did through '08, right? Because you sold prior to '08, correct?
We actually sold in late 2006, and we had a 2-year earn-out commitment, so we got to watch it through that period of time. They actually did really well. Part of it was driven by quick reaction time to worsening credit and got the benefit of people pulling out of the market of providing credit. So, we got better quality customers and continued to expand its product set. And they've done a great job under the new leadership. And a lot of the people that we had as part of our team went on and did great things, whether it's build big startups or run big companies. Some are still there. So that was my first company. And then we just happened to have some liquidity because, like you said, '08. And I always liked real estate. So we ended up building a real estate company starting in 2009 to buy distressed assets. And we focused on multifamily or apartments.
Pretty
So
good time.
we built. Yeah, no, in hindsight, it was a pretty good time to buy assets. It was,
It didn't feel like it at the time, though, I would imagine.
It was kind of a scary time.
Yeah.
Yeah, a pretty tough time to go raise capital as a 26, 27-year-old kid. I think I looked like I was 15 at that time.
Were you still in Chicago?
I was in Chicago, yeah. So we started buying apartments in Chicago.
How old were
And
you
so
when you immigrated? Were you born here, or did your family bring you here?
No, I was 8 when we
8?
came over.
Did you speak any English?
No, not at the time. I'm still learning.
I think you're doing pretty well. All right, so then did you move to like a neighborhood where like it was, I mean, Chicago's got little pockets, right, where they only
Oh, yeah, for sure.
So you didn't really like when did you integrate sort of into American culture?
Well, so I joke about it. I was a little kid. I was 8 years old, and my older brother was 13. I think it was more part of the Soviet immigrant, Russian immigrant community. I fairly quickly picked up English. When you're a little kid, it comes pretty natural. So I was the ESL kid for a couple months,
Yeah.
and then fairly quickly I became the American kid. And I played sports, and I actually was really fully integrated. So we moved to Skokie, Illinois. And then my parents moved around every I don't know, every year to get a slightly bigger house. And I joke about it. So I have 3 young kids, and we worry so much about, do we change schools and can we move? And it's an amazing environment. And my parents, to their credit, they could care less. Like, we moved across the street. I went to a different school, and they're like, I don't know.
Yeah.
Yeah.
Yeah, well,
Good luck.
I think I don't know. I think our generation worries about that a little bit more than our parents. But I think our generation would be good to remember that kids are pretty resilient.
Well, that's kind of what my wife and I talk about is we're both immigrants. She also is an immigrant, and just it ingrains a certain, I think, adaptability in you. And at the same time, by the way, a love for America, because we came here for a better life with nothing really as refugees. And I think, there's a separate conversation that people question American decisions and whatnot. And I always come back to the fact that, hey, I'm just thankful as a little kid, somebody put me on a plane and brought me here and gave me this amazing opportunity set that this country provides.
Yeah. I mean, I think I told you my wife's family is Polish immigrant. She was born in Chicago, but grew up in the Polish area where like they only
big Polish community.
Yeah, they only spoke Polish. She didn't speak English until she was like 6. And you talk to her dad. I mean, they came here looking for a better life, and God bless him, he made it, and you look at what he provided for his daughter and what she's become. It's the American dream personified, and you are as well.
We try to remind our kids of that constantly, but it's all about lived experience. If you don't actually live it, it's very hard to digest it. And so that's, I think, the question, like you said, for the next generation.
Yeah. Well, I'm doing my best to raise soft children, so I have to harden them up somehow. I don't know how I'm going to do it, but we'll see. Anyway, that's neither here nor there. All right, so you started the real estate firm.
We started this real estate company. We started buying distressed stuff. Scary time, obviously a financial crisis. This was really before TARP and TALF and all these programs that brought liquidity back into the markets. And we ultimately built a pretty big business. And we actually did it in a holdco structure, in a holding company, as opposed to a traditional sort of deal by deal or fund model, because one of my lead investors convinced me that that is just a better way to create alignment of interest and ultimately get to a point where when you choose to sell or go public, you're going to have one set of decision makers to make that call. And so we set up a private REIT called Pangea, like the supercontinent. We
Yeah.
had visions of grandeur and built up a pretty nice business. We bought and renovated 15,000 apartments over the course of really 6 or 7 years.
Wow.
And built up our own management company. So we were operating workforce housing, sort of, challenging assets and challenging neighborhoods that you really have to manage very, very closely. So we built up that full capability set. So we were
What kind of neighborhoods are we talking?
urban Chicago,
Yeah, like give me
Indianapolis.
streets.
Oh, you know those streets?
Yeah.
Oh, I mean South Shore.
Okay.
Chatham. Auburn Gresham. Great neighborhoods, amazing properties, by the way, amazing real estate that could never be rebuilt. But neighborhoods that do have crime, that have high unemployment, that historically have had challenges.
What did that teach you, owning assets in those neighborhoods? I mean, did you come in with any preconceived notions and then leave thinking something different, or not really?
Yeah, I'm not sure. I think we tried to always leave the preconceived notions at the door as much as possible. It's hard to do, but I think my experience has been that you just have problems and solutions, and you try to really solve them one at a time. And I think my takeaway is these are neighborhoods with great people and neighbors that, they have challenges. There's, like I said, crime and unemployment and certain issues that hurt the neighborhoods, but you have great communities of people that are amazing, and they're loyal, and they're just looking for great products and services, and that's what we try to provide. But the takeaway from that experience was you really have to be on your game. You have to be able to execute very quickly. You have to be able to solve problems, fix issues in the buildings, make sure you deliver a high quality product, and do that in an environment that other operators in real estate maybe can't do. And if you do that, you get amazing loyalty. You have tenants that been with us for 10 plus years, that the buildings have continued to perform great. The portfolio has performed amazingly well. Even now that we've actually sold the portfolio, we get to see that it continues to perform well.
Yeah, that's neat. I like the idea of, I mean, some of those would almost be like opportunity zones today. I mean, I don't know if they're technically designated as such, but I like the idea of like going in and
They
investing.
definitely are.
Investing in the community, providing services that other people aren't willing to, and that's like win-win.
Well, we've done some amazing things down there where we created a sister foundation. So Pangea Properties is the name of the real estate business. We created an entity called Pangea Cares, which basically just reinvested in the communities in which we operate, with after-school programs and internship programs. And it's kind of this circular construct that does work really, really well.
Yeah, that's dope.
And so that's been phenomenal. So that was really my life professionally from 2009 to really full time through 2014 or something like that. When I was running the business, I was CEO. And then I took a step back to become chairman of that business, and I'm still chairman of the business today, even though we've now sold most of the real estate portfolio. And I started a company called Avant, again, focused on the middle income consumer lending category. We now call that fintech. At the time, at least the first time around with Enova, I don't think fintech was really a moniker people would use.
Yeah. What about the consumer lending area, like, provided a lot of opportunity that you saw and made you want to enter it, not once but twice?
Yeah, well, I think I told you I'm not very smart, for one. So no, I joke about it. I mean, I think it's this really idea that with better data, better analytics, and better technology to deliver products digitally, it really is a math problem. So when you kind of think about everything we're talking about with AI and LLMs, we've been focused on developing better models, machine learning models, to drive better credit decisions for 20 years. And the idea is pretty simple. if I can underwrite to the best quality consumer, and why I define quality is lowest risk consumer, I can offer that consumer a lower rate of interest on credit. And I don't know why I have fireworks.
That's amazing.
Awesome.
Look at that. It was like your computer was ready when you hit the punchline
exploded.
there. It like exploded.
I think this might be my kids taking over my computer sometimes to do their Russian school. So anyway, it's the math problem of it. But at the same time, it's got that same dynamic. If you provide a great quality product and service to customers that have been generally left behind by banks have chosen over a long time horizon to walk away from serving the middle income and the non-prime, subprime consumer. I think if you could provide them great products, and Avant focus is unsecured personal loans, credit cards, expanding that product set over time, that customer is going to be very loyal and very happy with you for a long time horizon.
How long is the typical loan that you would extend?
Avant's products are 3 to 5 years on the personal loan side, and then credit cards.
Yeah.
So credit cards obviously a revolving line of credit.
Interesting.
And it's been fun to watch that company develop. And so as part of that development, eventually we actually split the company in two. So we built a bunch of technology for ourselves. We started selling that technology to banks who were trying to do the same thing we were trying to do, is improve their customer experience. And so what we ended up doing is deciding to split the company into the two parts. So you have Avant, which is a pretty big consumer lending business, one of the top 20 or so credit card issuers now in the country by just number of customers, a couple million active customers. And then you have Amount, which is a pure technology company that took the technology that we built for ourselves, rebuilt it, replatformed it, and then offers it to banks as a partner where banks can use it to improve their own digital experiences. So that was sort of my professional life from 2013, 14, full-time until 2020 when we split the company in two and I became chairman of both Avant and Amount.
Okay. And then you said, I don't have enough on my plate because I'm chairman of Pangea, and that's kind of gone, not totally. And then I've got these two companies, so I'm going to start Stoic Lane.
Yeah, like I said, not
it's not about being smart. I do wonder if you have an off switch. Do you are always going? Is it like, do you need that internally?
I'll tell you, we had a phenomenal experience as a family. So we have 3 kids. They're now 8, 10, 12, but 2020 was obviously COVID.
Yeah.
And we split the company Avant in February of 2020. March of 2020, COVID hits. And then, my kids are out of school for over a year and they were little. And I was pretty burnt out, and I had always wanted to go travel with the kids for some period of time. And so my wife and I actually did that. And so we went and we spent 6 months, maybe 5 months, traveling around the world during COVID, which was an unbelievable experience for our family. And yeah, nobody was traveling, right? So it was kind of a crazy time.
An aggressive decision that I respect very much as somebody that came to Florida.
Yeah, no, we had this unbelievable experience, and I feel like it really created this bond with our family, and hopefully our kids got to see some stuff that they would never see.
Yeah, I'd imagine.
But for me, that was a great catalyst. I think it kind of like reinvigorated this fire to want to build something really big that's hopefully multi-generational, which is what Stoic Lane is. Stoic Lane is really modeled on, obviously Berkshire Hathaway is one of the largest, most well-known longer-term investment platforms, but Constellation Software, Danaher, Liberty Media, IAC, that was the vision that I've been thinking about for a long time, this idea of creating a longer-term operating and investment platform that will just be able to benefit from that longer-term compounding, but at the same time use technology, use better operational capability, adopt, the next most important advancement a la AI, to drive better longer-term efficiency across businesses in my world. In my world, being where I've played my whole career, which is financial services and real estate.
Yeah. So you say in the one pager that it's FIRE, right? So financial services, not insurance.
Well,
the RE is real estate, but it's like accounting firms, right?
Well, so originally we said FIRE, finance, insurance, and real estate.
Okay.
It was a little catchy. And that's what we didn't know what we were going to do. So that was sort of the broad lane. And it's pretty broad because fire represents 20% of GDP. But what we've done since is we've really created two core platforms. And we have a real estate services platform where we've assembled a couple of really large companies that are some of the biggest companies in the US and what they do. And then we have a platform we call Financial Solutions, really back office services for entrepreneurs and small businesses.
Okay.
So that's what we built. And
So let's put a little bit more of a fine point on that. The real estate company, the operating companies, what exactly are you doing?
yeah, so I think our core strategy, and again, don't forget, we were starting the business in early 21. So we officially launched Stoic March of 2021, raised capital for the first time in August of 21. This was sort of the heart of, zero interest rates. Every asset was being pumped, SPACs, crypto, you name it. And personally, I have a value bent, and just the way we were kind of thinking about it as partners, where can we go where we can buy companies at reasonable multiples of cash flow instead of paying 50 times revenue for minority stakes in startups, but at the same time get that long-term growth. And so what we really came up with is this idea that we are going to buy small operating businesses. We're going to focus on professional services, so asset-light companies that are highly fragmented, that are not using a lot of technology, buy up those companies, create scale by putting them together into a larger platform. So step one is integrate those businesses to create scale. Step two is really use best-in-class technology, systems, optimize the businesses to actually get the benefit of scale. And then longer term, step three is drive growth and better margins over a long time horizon using tech, AI, outsourcing, sort of you name it. And that's what we've done. And so we did that in vacation rental management, where we assembled the second largest vacation rental property manager in the US. We call it Monarch. We've done that in real estate valuation or appraisal in a platform we call Ascribe. And we're now doing that across accounting in a platform we call Archer Lewis.
What have you experienced in the portfolio side of like the Airbnb, for lack of a better term, rental management? Seems like, 2021, 2022, you were right in the teeth of a ton of demand. Has that sort of softened at all, or is it still pretty, what do you see from your lens?
Yeah, no, you're totally right. I mean, the initial COVID wave obviously was challenging for that whole industry because everything was shut down for a period of time. And then everyone started traveling and nobody had to be in an office anywhere. And there was stimulus money and liquidity everywhere. And so those companies all grew like crazy between really 21 and 22. So we got into this space in the very end of 2021. We bought our first platform, and then we really scaled in 22 and 23. And I think our assumption was that was going to stop and that it was going to be a softer period of time, and that was going to come off a little bit. And you were going to have a couple of years of stagnation just in occupancy, average daily rents or ADRs, RevPAR being the combination of those two factors. And that's really what we've seen. So the last year was a tougher year in the whole industry. The overall RevPAR was down 14, 15%. This year's continued to be a little bit slow. Challenges with supply, too much supply that came into the market depending on what market you're in. We've purposely stayed out of cities, so we don't generally operate in urban markets. We operate in traditional vacation markets that don't have nearly as much supply, that don't have, the Airbnb arbitrage model, if you will. Basically, people that will rent a unit from an owner in an apartment building and then go on Airbnb and lease it out and try to make the spread. We don't typically compete with that. So we don't do any of that. We manage homes on behalf of homeowners that have a second home. They might have a second home in Lake Tahoe, in the Panhandle of Florida, in Seabrook Island, Georgia, you name it. And we try to provide them this great experience where they don't have to deal with it. They get a check every month. And then when they choose to come and stay in their property is going to be spotless. And it's going to be well taken care of. That's the experience we try to provide. And, I think we've done a pretty good job in maintaining growth and improving growth. And it's still a challenging year in the market. But I think we've kind of done a pretty good job of improving how we think about pricing and getting the benefits of scale. And so we're actually growing. whereas the industry continues to sputter along right now. But I personally think the whole industry has gone mainstream. With COVID, so many people have discovered that you don't have to stay in a hotel when you travel. You could find us on Airbnb, VRBO, HomeAway, or you could find us directly. But then once you have that experience and you've gone and stayed in a house with 3, 4, 5 bedrooms and a yard, it's pretty hard to want to go stay in a hotel room. It's a totally different experience.
Yeah, well, especially now that you don't get your hotel room clean unless you make a special overture to somebody to do it. Right? It's
Exactly.
one thing when you're getting service associated with it, but if I don't get my service, then I might as well, especially if I'm traveling with the family, the Airbnb model is much better for me.
Well, that's what I think it is. We travel all over the world with my kids. We stayed in Airbnbs and homes all over the world, and we had a great experience. And like how we use Airbnb now as this noun or VRBO or HomeAway, I think they're great companies as marketing companies. But I travel by myself. I go to New York. I was in New York yesterday. I stay in a hotel because it's easy. It's simple. I don't have to think about it.
Yeah.
But if I'm going traveling with my family for a week and I need a place to work and I need some room for the kids to sleep, the hotel housing stock isn't built for that.
Yeah. Well, and then you get in 2 rooms, and once you start doing that, the cost gets crazy. So it's a nice value proposition. And your strategy is to do the asset management side of it, but you don't have the capital outlay. So if I would be a customer theoretically that owns a second home, I'm the one that holds the assets, and then you sign up with me and you send me a check, right?
Correct. Yeah. We don't own the properties and have no interest in building up the asset base. Our interest is providing the best experience we can to our owners. And in some cases, the owners may choose to buy multiple properties. So we have owners that own, 15 or 20 properties that we manage for them. And that's great. And our whole focus and goal is how do we operate our business most efficiently, and how do we provide the best cleaning services, and how do we price most effectively? How do we provide them the best APIs and onboarding into VRBO, HomeAway, Airbnb, Expedia, making sure that the most new guests find them, but at the same time also provide them great websites so that repeat guests that want to stay with them directly can stay with them directly. So it's really focused on the operating side of that experience. And then ultimately the goals are pretty simple: is you want them to have great income, and it's totally passive, and at the same time, great experiences when they stay in their homes. Because most of our owners stay in their homes.
Yeah. Yeah, that makes sense. It's sort of like a way for them to cover some of their expenses while they're not utilizing the home.
Exactly. They might stay in their home 3 weeks a year, maybe 4 weeks a year tops. The rest of the time, the home is just sitting there underutilized, and it's taking on just sort of natural wear and tear.
Yeah.
And so this way they get to offset that cost. And then people are in the house, they're checking to make sure if a pipe burst, we catch it pretty quickly, that kind of thing.
So do you have like regional managers that I guess what I'm trying to figure out is you mentioned, decentralized operations, right? And constellations. So like how does that permeate what you do, and how does that apply to what you do?
Yeah, so the way we've scaled is we've bought 24 companies, individual companies, to create this platform, Monarch. And these are amazing companies that have been around for a long, long time. In Lake Tahoe, we have Tahoe Getaways and R&R. In Aspen, we're Aspen Signature. In the Panhandle of Florida, we have a company called Benchmark and West Beach. And basically our strategy is we want to preserve the long-term value in brands that we have acquired. We don't want to destroy those brands, because a lot of times those brands have been around way longer than we've been around, and they've great experiences, great reputations. And so that's what we try to do, is we try to incentivize the owners to stick around as long as they want to stick around, and try to make their lives better so they don't have to deal with the administrative stuff that they, in a lot of cases, don't want to deal with. So the back office, the accounting, the HR, and they could focus on dealing with, their clients, on finding new homes, on being in the community. And so that's a big part of what we're trying to do, back to the decentralized management. And then centrally provide them the support for the administrative side to make their lives more efficient, provide them technology services that they historically couldn't afford, provide them data and analytics so they could think about how do they optimize pricing most effectively, how do they figure out how to scale vendor relationships and get better pricing on linens, sort of you name it. And it's worked really well. And I think that hybrid approach where you can go to the property that you've gone to for the past 15 years and it still feels the same, it looks the same, you get the same quality touch, but maybe it's even a little bit better because now you have more consistency. Now, you can have kind of some features that historically you didn't have because we're trying to learn. So we're taking what's working in one market and trying to apply it to a different market.
Yeah, that makes sense. How do you think about, to the extent that you can talk about it, how do you think about incentivizing the owners that are staying on in order to keep them motivated?
Yeah. No, I mean, we really focus on long-term incentives as part of this idea of how do you continue to scale and grow a business for a long time. So it's not only the owners, obviously all of our key employees and executives. So it's really a function of when they sell, a lot of times they'll take a piece of the go forward business of Stoic Lane as part of their compensation. So they have incentive there. And if they want to stay around for a long time, we'll try to create the right incentive to match what they want to do. And we've heard this from a number of owners where of the 24 companies that we've acquired, 20 owners are still with us, which I think is, and this is just in our vacation rental vertical, just to be clear. And I think that's a huge win. We're super excited about that. And a number of them thought that by now they would have retired, they would have moved on. And they've told us, we're sticking around as long as you're here. And so that to me goes back to why are we doing this? I think that's the piece that I get energized about.
So something that you said, you give them some equity or a piece of Stoic Lane. I'm not trying to put words in your mouth, and if I misspoke, I'm sorry. But the thought that I had, you're talking about long term. Do you mind talking about how Stoic Lane is set up? Because when we first talked, I think it was about 45 minutes into the conversation, I was like, "Oh, so you're a GP?" And you were like, "No, no, 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 no. It's nothing like that." So I think it's kind of interesting the approach that you've taken.
Yeah, so we're basically a company. So we're an investment company. We have shareholders. I'm one of the biggest shareholders personally. Our shareholders have preferred shares in the company that could convert to common if we go public, which is our long-term strategy. And then management incentive, in a private equity firm, it would be carry. Management incentive is really in the form of common shares that vest based on performance. And so we create alignment of interest between our investors and management by tying it to really long-term outcomes. And so our goal is to create compounding multiples of capital that translate to hopefully 25 or 30% annual returns for the next 10, 15, 20 years, right? Nice and easy, right?
Yeah, easier said than done.
Yeah, well, I joke about it. It's easy to build a model that shows that because I think what we're doing translates, on a model basis to significant long-term returns because we're buying companies at reasonable multiples, market multiples, but they're small companies. And so typically we're buying them for 5 times cash flow. That's kind of our model. And you put them together into these larger platforms, in theory, they're worth a lot more. And so that translates to high returns. The theory, though, the big test is, can you actually operate these businesses? Do you keep management engaged? Can you continue to grow as they're part of a larger platform? And I think that's kind of the skill set that we're trying to bring to the table, is that really have a unique experience. So that's the structure. And the long-term goal is how you create significant multiples of capital over a long time horizon, 10, 15, 20x for our investors.
Yeah, and the other thing that you had said to me is, I think when you're thinking about, running this for a very long time, right? I mean, my interpretation of our first conversation was not that you necessarily regretted selling your first business, but you watched it become what it became, and you thought, next time I want to hold that compounding for as long as I can, once I get the right wrapper, if that makes sense. Is that fair?
Yeah, I think no, for sure. Like I said, I've been a student of these amazing leaders and CEOs. Mark Leonard at Constellation, and obviously Buffett and Charlie Munger and a number of others, John Malone and Liberty Media, that have built these amazing businesses, but they didn't do it overnight. It took years, 20, 30, 40 years to really get to the point where these companies were really scaled platforms. And so we think of ourselves really just in our formative stage. We're 3.5 years in, and we're just kind of getting our feet wet, hopefully. And so our view is we could continue to expand. So we really have these two core platforms. Our platforms can grow horizontally as we find adjacent opportunities that make sense, where hopefully we have benefits of already being in a business where we have adjacency of having great young leaders that could step into roles as CEOs, as product leaders, as technology leaders, as chief revenue officers that we're kind of building up, giving them great opportunity. And I ideally create these amazing advantages that can continue to multiply. So that's really our view. Our real estate business, Pangea, we started in 2009. It was a 15-year journey. My hope is that this is, like I said, 25, 30 plus year journey, and we could continue to deliver amazing outcomes for our shareholders, but at the same time, continue to really foster these great brands that have been delivered and that have proven out in their first ownership by these great founders. And what we promise these founders is we're going to do our best to protect your legacy. So you could continue to build it. You can eventually retire, take a step back, but feel comfortable that your legacy is going to be protected.
Why did you exit Pangea?
So we sold the portfolio. I think, ultimately the challenge with any business is, are you growing? And if you're not growing, can you continue to motivate the young team? And we just really weren't growing. Because I think the challenge with real estate is so cyclical. And we bought real estate from 2009 to 2014 or 15. And we really didn't buy much real estate from 2015 on because we just thought the prices were too high. And, ultimately, I think we should have kept going. And eventually prices corrected. But we just felt like if we weren't going to continue to grow and didn't see opportunity to continue to grow the real estate portfolio, it made sense to explore the market to sell it.
Interesting. So what did you experience as a leader when the growth sort of slowed? I mean, obviously you alluded to keeping the team motivated, but I'm just kind of curious to hear what happened there.
Yeah, I think that's just kind of a bit of the challenge is when you're growing the business, and Pangea grew from 0 to 500 plus employees in 3, 4, 5 years. And, obviously it's crazy. You're trying to make sure you have a good process and you're trying to improve all the time, but you're really, it's exciting. You're pushing forward. And at a certain point when you're not growing as quickly, it doesn't mean obviously the business collapsing. That's when you actually become very profitable in theory, because if you're doing your job well. But then you have young people that are looking for that next opportunity that might not be there. And I think that's a bit of the challenge that we saw. And that's actually part of the opportunity set at Stoic Lane is we may have one business that's not really growing, but hopefully we have another business or two that presents great opportunity for people to move to.
Yeah.
But that was a bit of the challenge is how do you continue to give that next generation of people amazing opportunities that the prior generation had?
Yeah, that makes sense. And yeah, I would imagine as it gets stagnated, it's just tough to convince, you start to not retain the talent, and it's like, okay, well, and I assume what you sold in 2020 or 2021, something like that, 2019.
So we sold in a two-part transaction. I say it was a long deal, it was complicated, but we sold originally the first part of the portfolio in 2022 and the rest of it, end of 23. So
I suspect it was not so bad in the end to
it worked out great for our investors who put their trust in us, and ultimately, like we have raised capital from outsiders. Our outsiders eventually want liquidity, and so we thought we might get a chance to go public as a company. We didn't for a number of different reasons, but also growth, right? Like we didn't have that growth engine available to us, and so we got liquidity back to our investors by selling the portfolio. I think at Stoic Lane, the plan is to go public, and I think we'll have hopefully the opportunity to do that because of the diversity of our businesses and the ability to keep growing for hopefully the next 10, 15 plus years.
One of your verticals is accounting, and I think that there's a few companies. One is an Australian listed one that's trying to do something similar. So how are you finding the bidding opportunity for accountants and accountant firms? Is it more competitive incrementally, or is it kind of, I don't know, fairly stable?
It's pretty interesting because it feels to me like a lot of investors and private equity investors and search funds have discovered the opportunity in the accounting sector at a pretty similar time, but it's still really early because we've been thinking about the opportunity set for the last year and a half, 2 years. We started buying platforms, companies earlier this year. A few folks started in the last couple of years, but it's a highly fragmented space. There are 40,000 accounting firms in the US. Many are very small. The subsector of the market we're focused on, these are pretty small companies, which we like operating in that space, but most people don't necessarily have the stomach for it. It's hard to execute on. You have to be really efficient. So we think there's still opportunity, but it's challenging. We're definitely seeing competitors come into the space, but we think it ultimately comes down to how can you execute? Can you actually operate, and can you integrate these companies and preserve the culture and the values of the business that you're buying? And we think that we have a unique ability to hopefully do that over time.
Yeah, I would think with accountants, especially some of the smaller firms, there's some element of key man risk too, right? I would think it's very relationship driven.
Yeah, I think that's true across our businesses. I mean, that's what we've gravitated to. It goes back to if you can execute on that transition and make sure that people stick around, and ultimately you can keep the relationships happy, I think you do incredibly well. But if you just buy the companies and you're an absentee owner and you expect them to work, it's just not going to work. So, yeah, it's very similar dynamic to our vacation rental business. It's a relationship. Ultimately, you could fire your manager if you want to. And I think we've done a pretty good job of providing a great experience and great opportunity set for the owners that have sold to us. So, like I said, 20 F24 are still with us. Our hope is that that's consistent in the accounting vertical, that sellers really, really get excited about the Stoic Lane vision and continue to be part of it. And therefore, we have these smooth transitions that take a long time and hopefully are pretty seamless, that the clients actually get better features, better services, and don't decide they don't need to move on. They don't need to try to find somebody else.
Yeah, I mean that it makes sense to me, and at least on paper, it's the execution that's the tough part, right? As with
No,
everything.
100%. Like me personally, for better or for worse, I like taking on execution risk. I don't want to take on market risk. I think market risk is this idea that I'm buying something because I think it's going to go up in price. Like, I don't, that's not my strength. I've never been a trader. To me, we're buying something that if we can execute on our plan, will create value because of the plan. But you have to execute on it.
So how do you think of yourself as an investor? I mean, are you willing to maybe pay a little bit more and bet that your execution is a little bit better so you'll be able to create more value? Or are you trying to buy things at like rock bottom prices and improve them? Or, I mean, I know that's obviously the holy grail. I'm just trying to think of like your philosophy generally. I've talked to a few people that run companies that now they have shifted from trying to buy like cheap turnarounds, for lack of a better term. They like to pay a little bit more and get a little bit better of an enterprise, and that's like in the private world as well.
The Buffett transition. Yeah, I think we're definitely we're price takers. We're looking to pay basically market because it's a competitive market. We're trying to buy companies that are good companies that are growing and they're effective without us. And because I think that means that with our help, hopefully, and part of a larger platform, they'll actually grow faster and they'll be better. But we're buying small companies, and so the market price for smaller companies is just lower than bigger companies. And so our view on value is if we can execute on this idea of creating scale, creating a unified brand, creating kind of consistent growth, the market will reward us with a higher value based on the scale. So we don't need to squeeze our owners. We want them to feel like they've gotten a market price, they've gotten a fair price. We just want to be the easiest person for them to deal with, so they want to work with us.
Now, when you say a unified brand, are you talking about, and I'm only asking this because you had mentioned the real estate companies sort of operate in regional brands. So are you more talking about like what owners think of you as, or in the accounting vertical, are you actually rebranding and going to market with like one brand?
Yeah, I think it depends on the market. And like I said, in vacation rental, we're keeping the local brands, a little bit like the hotel. Marriott has a number of different brands that they operate. It's a little bit of that concept. In our other verticals, we tend to go with one brand. So our appraisal real estate valuation business was 8 different companies that now are all operating under one brand we call Ascribe. And they're doing great. They're providing great service. Our accounting business is called Archer Lewis. So ultimately, all those companies will be operating under that brand. And I think that just creates consistency for the clients over time, creates a more unified experience. And so even in our vacation rental business, we have different local brands, but then there is one unified brand over the top, which is called Monarch.
Yeah. So is it like I don't know, Bill's Property Management, a Monarch company, basically?
Correct.
Okay.
Exactly.
Yeah, that makes sense.
Exactly.
What's gone on in the real estate appraisal business? I would imagine that rates have sort of punched it squarely in the face. I know, you execute as well as you can, but when you're swimming against a tide like that, it can get very difficult.
Yeah, it's been a challenging few years. We came into the business underwriting high rates, and so we assumed volume would come off. I don't think we quite assumed it would come off as hard as it has,
Yeah.
where there's effectively no refinance business. If we're talking about residential real estate, there's zero refinance activity, and purchase activity is at 40-year lows in the industry. Yeah, so we've definitely been challenged based on that. At the same time, I think we've executed pretty well. And so we're just integrating the company into a cohesive platform, and we're picking up market share because I think our clients, basically banks and lenders, servicers, are happy with a unified national platform that can deliver quickly and efficiently for them. And so, it's been challenging, but I think we'll get to a good outcome there long term.
Yeah, well, it's not perpetual, right? But a temporary blip for sure.
Well, I think the market's stabilized. Mainly how much worse could it get? But it's pretty bad.
That's fair. That's fair. If you do any office, it could get a little worse. But then again, you might need appraisals for handing the keys back or whatever. We'll see.
Yeah, no, I think we're excited about where that business currently stands, and it's been a challenging 12 to 18 months, but we're really excited about the growth that we're seeing now.
Do you see any like sellers of appraisal? I mean, what's the bid ask spread on some of those businesses? I would imagine if you have one, a willing seller is hard to come by, I guess, is what I'm thinking.
Yeah, there really hasn't been that much activity. We're excited to be in the market. We'll look at opportunities to get bigger and get to scale. We're the 5th largest appraisal company in the U.S.
Are you really
Our
already?
goal in it, yeah. So that's what we've put together. Like I said, we've created a national platform.
Yeah.
Our goal is to be much larger than that. So we do something like 20,000 appraisals a month, like pretty big company, relatively speaking. Our goal is to be number 1 or number 2 in every market in which we operate. So we'd love to find ways to scale and get bigger through acquisition and organic growth. So we're just looking for opportunity.
Yeah. Generally and philosophically, how do you think about sort of building moats in these different businesses that you have? I'd just be curious to hear you riff on that.
Yeah, no, I think it's a great question. I think my experience has been, one of the challenges for real estate, my prior experience where we were buying real estate, is that pretty much anybody that had capital could compete with us. And that's why we ultimately sold the portfolio, because there was just too competitive. Prices kept going higher, and we couldn't find anything to do and anything to buy. And so we like the idea of competing in operating companies, operating businesses, where you have business complexity, the capital markets are more challenging, you have to have experience. So you have a limited set of competitors that come into the market. Basically, we compete with middle market private equity firms. That's who generally is going to try to buy these same companies we're trying to buy on the one end, and then strategics on the other end as we try to grow these companies. I would say on the buy side, part of it is we go into verticals where you don't have a lot of platform companies, bigger companies that private equity firms can come in and buy. And we're built to buy much smaller companies, and we built the platforms. So I think that's a unique advantage of our Stoic Lane thesis and how we execute. I think longer term, it's better execution drives barriers to entry. So better execution and continuous improvement. That's been my experience. Because over time, technology all gets copied. It's whatever unique kind of like formula you have, somebody's going to figure it out. You drive better execution with better culture, better people, and then continuously innovating and cannibalizing what you already do. And so that's been kind of my focus. Is there's this book I read years ago that I think lays out culture in a formula that, like it's a way of thinking of the culture code, which basically says if you study SEAL Team 6 and you study winning sports teams and you study the best performing businesses, what drives them is culture. And culture is basically having a unified vision of where you're going, having a team that has trust so you can make mistakes and be okay and you're not afraid to make those mistakes. But at the same time, people will call out what's going on. And so you're learning from those mistakes. And, that's what we try to do. We try to create great environments for the smartest, the most hardworking, energetic people that want to come work in. And ideally, we try to recognize who they are and try to push them up as quickly as we can. And I think that drives better culture long-term, meritocracy, and ideally, better results. And so you could try to compete with us today based on what we have, but hopefully by the time you're there, that's 12, 18, 24 months down, we're so much further because we're constantly trying to reinvent ourselves.
How did you pick, the co-founders that are listed are Jake Nice and Matt Foran. How did you all come together?
Yeah, so I've known, most of our team, they're people I've worked with in the past, I've known for a long time. So Matt Foran was actually my high school fraternity brother. So I've known him forever, 25 years at this point. I joke, I think I ran his lines for his Butch class at some point. We still get along, so who knows? But him and I have actually never worked together in the past, but we've always tried to because he was in the insurance world, which is where finance, insurance, and real estate.
Yeah.
It's very operational. And he previously built a startup that I was too dumb to invest in, and then sold it to a big insurance company, and then ran distribution for another very large insurance company, and just really knows that world. And I think our experience, because I have more of the financial services, real estate side, he has the insurance side, just blend together really well. And so we came together around this idea. And then Jake Nice, I actually pulled out of investment banking, and he came to work at Avant as he was, I think, employee 25 or 26. Yeah, his second job, after investment banking, he worked for a former boss of mine, which is how I met him.
Huh.
And so that was over 10 years ago, and he was phenomenal. He ended up leaving us for his wife's residency to go and move to Columbus. And him and I always talked about getting back together and building something. So he was just this, again, back to young, hungry, smart person that I've had a ton of success working with those kind of people over many years. And we just came together around this idea in COVID times and said, okay, we all believe in this longer term compounding strategy, and how do we create something that's going to outlast the three of us and ideally surround ourselves with people that think very similarly. And we're 4 years in, still kind of moving forward. We have great teams that we've built around us, and the Stoic Lane team's about 25 people at the Holdco, which is really supporting about 800 people across these various businesses that we've built up.
Yeah, interesting. I wish I had more Holdco experience so I could ask you more relevant questions. I'm interested in how you build it. How do you keep the team motivated? Those are some of the questions I keep coming back to. But it sounds like it's.
I keep asking myself those same questions. But I think ultimately, like, my experience is if you are surrounded by really smart, great people, it just rubs off. And that's what motivates me more than anything, is just working with great people who are fired up to go build stuff. And we can figure out the economic incentives. We could figure out, okay, like if we're building value and the business is doing well, hopefully there's money to go around to make people happy. But to me, the biggest motivator is really just being on a winning team. And, I grew up playing sports. My kids play sports. I'm a big believer in that. Winning is fun. Everybody wants to win.
Yeah, losing sucks.
Losing sucks. Nobody wants to lose.
No.
But I think being part of on a winning team professionally just means you're surrounded by A players who are pushing hard, who are driving hard, and are teaching you stuff every day. So I'm coming to work to learn stuff from, I was the young kid. Now I'm one of the oldest people around the office, which, kind of happened like that. But I'm learning stuff every day, which is what motivates me. And I think that's circular. I think that's this virtuous cycle we're trying to create.
How do you foster you had mentioned, the idea that people are willing to speak up and disagree. How do you foster that kind of an organization?
Yeah, I think it's a great question. I don't think you can do anything but just have it happen and react the right way and try to have just open dialogue, try to bring people in the tent and encourage people to participate. And I think people kind of see that it's okay. I think in a big company, it just where you have a lot of bureaucracy, it's very hard because nobody's doing it. So are you really going to be the first one that says, "Hey, like I got here 4 minutes ago, but I have this idea"? Like people just don't do that.
Yeah.
Whereas if from day one it's pretty clear that, hey, I might have, I might be CEO, whatever that means, but everybody constantly tells me all the reasons I'm wrong, and I'm okay with it. Like, I think you get the hint.
Yeah. Yeah, well, it seems to be a commonality of different organizations that are probably largely tech focused, but there was a guest on here. He wrote a book called The Geek Way, and that was one
Okay.
of the sort of foundational principles of a lot of the businesses that he has followed and kind of admires is the willingness to foster not necessarily agreement and not necessarily disagreement, but honest conversation.
Yeah. Exactly.
Because who knows? I would be remiss if I didn't tell you we talked about winning and losing. My grandfather used to say, "Show me a good loser, and I'll show you a loser." So that's
I,
my grandfather's
I,
wisdom.
oh yeah, no, I can't say I don't say similar stuff to my kids sometimes, even though I regret it.
Yeah, I don't know that you should regret it. I think it's a good lesson. I mean, when you're talking to your kids, and like, how do you put into perspective what you had growing up versus what they have now? Can you?
Yeah, I think I don't think so. I think it's really hard. My wife and I talk about it. We're both immigrant kids. It's it's like a foreign language. It's lived experience. I think we continue to do it nonetheless, and continue to just kind of. I actually think sports is a great allegory for life, and it doesn't have to be sports. It could just competition in general. It could be chess. It could be robotics. It could be anything. But I think this idea of being in a competitive environment where it doesn't matter how much money you have or your parents have, or do you fly first class or business or you fly private, like none of that matters if you don't perform on the field or you don't perform in your tournament, and you have to deal with that stress, and you have to be able to kind of interpolate it, put it aside, and still perform. I think that's kind of a great allegory for how life is. At the end of the day, you know, if if you get a little bit of help to get through college and get your first job, great. But you got to show up and you got to perform. And and that's what I try to tell my kids. Is like it doesn't matter. Like the material stuff is great, whatever. It doesn't really matter. Perform. Train. Training makes you better. Improve your skills, and ultimately you got to be able to deal with the anxiety. You got to be able to deal with the stress and perform. And if you do, things will turn out great.
I like that. That is solid advice.
I mean, I don't know if it'll work.
No, it works. It definitely works. I'm sort of dealing with it with my second. He's like naturally pretty good at a lot of stuff, but he's hitting this like plateau where his natural ability can only take him so far, and now he's running into kids that are working harder. And it's like, dude, you got to work. Like that's just what it is.
No, I mean, it's kind of amazing. I think I hit that natural ability plateau extremely early in my
Yeah, I did too. He
career.
didn't get all my genes. Those are his
Yeah, my
mother's.
wife, my wife is got the more the natural athleticism. I joke she gave the kids the genetics on the athleticism, and I have the cattle prod.
That's
Um,
okay.
but but I was a wrestler growing up, and like wrestling is a grind sport. You just got to work,
Yeah.
and I think it's like a great way to learn that you might be better naturally, but that lasts like a minute before the workers get ahead of you.
Yeah. Yeah, that is good lessons. The earlier we can teach them, the better too. Which is why I agree with you on sports, right? It's like something that cannot be denied if they care about it, or whatever your competitive desire is.
Yeah, exactly. I like sports, but whatever it is,
Yeah.
whatever gets you fired up.
Yeah, you can't fake it through chess, right? Like eventually somebody's
Yeah.
just better and they're gonna beat you. So
Yeah, of course.
yeah. Cool, man. Well, I've enjoyed the chat, and I like how you're going about what you're going about. I mean, like I said when we first started talking, I was like, oh, okay, it's a GPLP sort of like, not, I don't want to say like another one, right? But then you mentioned that it was a C corp and your long-term vision, and I'd be remiss to say that people should reach out to you if they like what they heard and they're potentially interested in investing, right? I think that would be a call that you'd be willing to take, and you
That
all
would be
you
awesome.
all can go through the formalities of accreditation and all that, but you are
That would be
looking to
amazing.
grow, right? So it could be
We're
worth a
we're
call.
looking to grow. We have till the end of this year to continue to raise capital, which we're actively talking to people that buy into our vision, and we have a long-term mindset. So could continue to hopefully be able to expand our opportunity set.
All right. Well, I hope that we introduced you to a few people here, and I hope that it was a beneficial use of your time. I'll have to make it down to Miami and say hi in person.
Yeah. Well, I'll make it your way too.
All right. Well,
Thanks,
either
Phil.
way, it works. All right, man. Have a good one. Stay cool out there. It's about to get hot.
It's a hot one.
All right. Have a good one.
I'll talk to you.